Good morning, folks. Welcome to the monthly roundup. Please just write a hello or a good morning in the comment box so that I know you can hear me. Hello, Maria. I guess you can hear me. Good morning, Sadbir. Good morning, Dilip. Good morning, Arjeev ji. How are you? Good morning, Shiv Shankar. Good morning, Apurv. Good morning, Suhas. Good morning, Dr. Manta from Guwahati. Good morning, Tamal. Any of you from Bangalore? We are doing this hangouts in Bangalore this month. Hello, Srinivas. Hello, Sayed. Hi, Manoj. Good morning. We'll start in 2 minutes. Please also share your views, how you're feeling in the market, whether you're liking it, your portfolio is doing all right, what is your expectation, whatever is your thoughts about the market, do share. Pune, yes, Pune, I'm getting a lot of demand to come to Pune. I definitely have to come to Pune. Mangesh, Suhas, yes, for sure. I have a meet in Mumbai in March. I will definitely try if I can club it with Pune also. Uh, Hi, Tamal from San Francisco. Namnail, how are you doing? Akshar Patel, good morning. Good morning. Good morning, Dilip from Bangalore. Okay, I think just few more seconds and then we will start. So the structure of this monthly roundup will be like every month, 15-20 minutes of my roundup about how markets have done, how weekend investing has done, and then opening up for questions. Once I finish, then you can start to write your questions in the comments, and I will try to take them up one by one. My target is 10:45, but if there are too many questions, I'll extend it to 11. Hi, Rajat. Hi, Prashant. Pune and Bangalore, along with Mumbai and Delhi, these are, I think, the top four cities where most people uh, have come to weekend investing. Surprisingly, more from Bangalore than even Maharashtra. So Karnataka is bigger than Maharashtra for our uh, statistic. Medhavi says, good morning from Dubai. Hi, Medhavi. Hi, Aditya. Good morning. So let's start. I think we have a good number to start. Okay, so amazing month, I would say, for November. I think this kind of a month doesn't come around very often. And we had a fantastic month. You can see that November started just around 19,000, and we've climbed this Mount Everest to 20,255 exactly in about 1 month. It took a month and a half to come down, and it has taken a month to go up. That itself is telling you how sharp the momentum is. Always look at the pace of the fall and the pace of the rise. Usually, the pace of fall is very steep, and the pace of rise is gradual. But whenever you find that pace of fall is less steep and the pace of rise is much steeper, it tells you the inherent strength of the market. It tells you that most likely you're going far ahead. Of course, there will be blips on the way, because as you can see on the daily RSI, we are already in the overbought zone. But so what? I mean, we were in the overbought zone here also in 2023 May. but we continue to do that. So you can remain overbought or oversold for long periods of time. This is just one indicator that you could look at, but the fact that the steepness of the rise is corroborated with a lot of news now, um, both justifying the rise. GST going up 15% year on year, uh, growth being upgraded from 6.7% to 7.5% this quarter, GDP growth. A lot of numbers are extremely positive. Pension funds relooking at India, pension funds wanting to come in 30, 40, 50,000 crores from there. FII flows having reversed into the green into India for month of November, and a lot of FII folks and many funds are actually momentum funds, so they are going to throw money at India like crazy now. So and just assume that, let's say you are a international fund and you are looking at 30 markets. Now one of these markets has hit an all-time high. I mean, you're not even looking into, what is the composition of that index and all that. You're saying, I'm going to allocate 1% more to that market. That is the kind of gross view a lot of these hot funds are going to take, that any market that hits an all-time high, just put more money there. So this is how, the importance of all-time high, the importance of momentum actually comes around, because an all-time high point draws liquidity into itself. Uh, and when the markets are going down, they basically let go of liquidity. So liquidity is what will define where the market will be at. On the monthly, you had the more than 1,100 point candle. If you will see the last many years, whenever there is a large candle, like a sort of 5% around candle, you will see that it will show you more continuation in that direction. So large candle here showing large candle here, large candle here, large candle here. Large candles usually are a sign that market is very strong, and hence it has more to go before it will give you something back. On the yearly, of course, last 8 years we've not had a red candle, so that is an amazing statistic by itself. Uh, Also, because since 2008, the money printing, or the way central bankers have behaved world over has changed, and that is the reason why we don't get these kind of 2, 3, 4 year kind of drawdowns anymore. So just see this entire chart of 33 years, and there are hardly, what, 6 or 7 down years. So by its inherent nature, uh, the market is set up to go up. So even if the worst of news comes, the market is set up to go up. So you can do all kinds of mistakes in the market, but the market is still trying to push you up. So that is the inherent advantage of being in the Indian market. A lot of people probably don't realize it, but really we are blessed to be investing in this market, which is now the fastest growing market in the world, a sizable fastest growing market in the world. And even if you did something stupid, the market is still going to reward you with something, and you only the only thing that one needs to do is not make too many stupid mistakes. That is the only thing the market is asking you to do. Rest, it is going to take care of itself. So if you have, whether you're doing momentum or whether you're doing anything else, just have a strategy which is not stupid, and you will get rewarded, whether you get 14, 16, 18, 20, whatever returns one may get. But any of these returns compounded over time, and if you put up sizable amounts in them, is going to see you through. It does not matter really. The best of fund managers don't have very high returns, but that's okay, because they are able to compound those mid-teens over the years. Small caps have resumed the upward rally after this break of few months, and this has been outstanding performance since April of this year. And there is nobody to say where this stops. I mean, a lot of, like for instance here, I think sometime October somewhere, Kotak had come out with a mid and small cap report that they are overbought and they should not be bought into or something like that. And we are already up almost 8% from there. So nobody will be able to call the market. You can keep trying, but the market will do what it has to do. And the only way one can really have comfort in investing is to just keep following price. Mid caps even better than small caps. The chart, strong move up, correction, strong continuation has started. It may as well go. I mean, if it has gone 10,000 points here, you may go to 48,000 here also, if you take it like a flagpole pattern. Uh, so very, very difficult to say at this point. Nobody could have said that the market is going up 50% in the next 6 months. Uh, so it's always a surprise mostly, and and hence staying invested, staying true to what the prices are doing is very, very important. This is very important that US dollar index has started to come off after hitting 107, and this week it also came very close to 102. I think back to 100 or below is very, very comfortable for emerging markets, and fund flow has started towards emerging markets as the dollar has come off. So whenever the dollar becomes too strong, funds move towards dollar based assets. Whenever the dollar starts to weaken, funds come out of dollar based assets into emerging markets, into precious metals and all those things. Now let's look at performance. So benchmark and indices performance on the top, weekend investing strategies on the bottom. Uh, Nifty has done 6.7% this month. CNX 200 has done 8.1%. CNX 500 8%. I mean, this for a monthly basis, these are awesome numbers. Nifty Next 50 up 10%, 10.7. Mid and small cap index 400 10.8%, and small cap 250 has done the best at 11.1%. Now let's look at weekend investing strategies. MIMT all cap 17.5% this month. Amazing performance. And let me tell you that MIMT all cap had underperformed last year, and a lot of folks moved out of that strategy. Even though, on a running basis, on a 3-year running basis, it has been continuously performing very well. But people got impatient and they moved out, and look at what they missed this year. So 17.5% versus its underlying of CNX 500 at 8.3. It has more than doubled the benchmark performance. Mi NNF10, again the same story, 15% up this month versus 10%, 10.7% for the underlying benchmark. Again, last year, NNF10 after the Adani saga had slumped and underperformed, but this year again it has outperformed like crazy. So you need to have a longer time frame, and trust and have confidence in the strategies that will come back. MI20 13.2% this month versus mid and small at 10.8%. MI25 again 13.1% versus 11.1%. MIATH was very slow last year, is now coming back 12.6% versus 8.3 here. MI Evergreen 11.4% versus CNX 200 at 8%. And now as gold is picking up, gold is now at the cusp of a huge breakout. So $2080 chart, I wish I had included this, has been tested now for the 4th time in 3 years. So it is a huge flagpole pattern, coming from $1,200 to $2,000, and then hitting that 2,080 3-4 times in the last 3 years. Now if it breaks off, I think we are going to 2,500 2,800, and in Indian rupee terms we'll go into 70,000s. Currently we are at 63,000 something. So a huge breakout is expected from gold, and Evergreen will do extremely well with that push from gold itself. Although without that push also it has done well at 11.4% versus 8.1%. MI India top 10, a 10.7% gain versus 6.7. Again, the same story with NNF10 and all cap. A lot of folks moved out of India top 10 last year because it had an underperforming year. So have a longer term view. 1 year, 2 years do not define any strategy. I would say minimum 4 to 5 years is what you need to have confidence over. HNI Wealth Builder up 10.6% versus 11.1%, sorry, versus 10.8%, just in line, I would say, for this month. MI30, 9.8% versus 8.3%, still a small beat. MI80H2, 8% versus 8.3%, just about there. NG5050 is 4.7%, not at par with Nifty and gold because of gold underperformance recently, but it is a good performance for 1 month for NG5050. Now let's come to sectoral performance. In 1 month, real estate has delivered 21.4%. I mean, that is amazing run on real estate stocks. Public sector enterprise stocks, 15.6%. There are stocks that are just mind-blowing rallies are happening, whether it is BHEL, whether it is PFC, REC, so many other stocks, Masdaq, HAL, amazing kind of performance. Commodities nearly 11% up, energy stocks 10% up. Pharma is making a huge comeback. I think pharma chart is one of the most impressive charts out there, where pharma index, after making a high in 2015, tried to break out last year, did not succeed, and now it is making that move. So it is coming out of a consolidation of 7-8 years. So pharma can really be the underdog. Autos doing quite well. The numbers are very good in November for autos, 9.2%. Infra is doing well. I mean, we are seeing on ground all around us. I mean, infra is a hot story right now. Consumption stocks, Titan, and all those Asian Paints, all those are extremely doing well. Metal stocks are doing well at 8.5% this month. IT has been slow at 6.4%, but 6.4% is also not less for a month. And FMCG is at 5.2%. PSU banks and private banks have been slow, but any gain on these, even 4%, is not too bad actually. So some charts, commodities you can see are breaking out into a new high. Real estate has been on a tear, just going bonkers here. And real estates are long cycles. Real estate cycles are not short. I've been crying horse for the last 2 years to get into real estate, whether in stocks uh, or in real estate. And people have been, every 10% move, people have been calling the top, and it has not yet happened. So real estate cycles are very long. In my own experience, in the last 30 years that I've been tracking real estate market, a real estate boom can last for 8 to 10 years in one cycle. So, I mean, if we started in 2020, we are in the third year. We've just completed 3 years of that. Metals about to break out. It has come to the 7,000 level couple of times, about to break out here. Autos are in a full flow. Just from COVID bottom, autos are up 3 times, more than 3 times since then. FMCG is breaking out despite the concerns in the last quarter that were there for rural consumption. I think that is coming back now with the kind of growth numbers that are there. Public sector enterprise in another orbit altogether. So, one second. So this is something that we should think about our biases, because a lot of folks never paid much attention to public sector enterprise stocks. They're stating that these are government entities, slow moving, decisions don't get made, lack of funds. But just see what this index has done. From 2000, we are at 7,000. So 3.5 times since COVID bottom on this index, and going up very, very, very rapidly. Energy stocks also breaking out from this 2022 high. This was a big crush when it happened in Feb of 2023. All recovered and going up. Pharma, as I mentioned, This breakout that had happened in 2021 out of the previous highs, the all-time highs were somewhere around 13,000, I think. This one failed, and we've now broken out and going higher. So this is a good chart. IT is kind of simmering, not really smoking guns, but IT is more or less following the Nasdaq patterns and going alongside. A spotlight for this week is NNF10. So let me just quickly go over this spotlight that my team has prepared. So this is what I was talking about, that this crushing blow that came in January, February 2023, which caused NNF10 to go from 175 to roughly 135, a 20-25% drop right here. And just see how amazingly it has come back from 134 to 201, almost a 50% gain since April. So since we went live on small case with this strategy, and this strategy is essentially only 10 stock strategy on CNX, on Nifty Next 50 stocks. Uh, it's been a good performer. It has doubled since we started in November 2020. So I completed exactly 3 years just 2 weeks back, and a doubler in 3 years is always welcome, versus the benchmark at 66.9%. So a good a performance. If we break down the performance, 101% versus 66% since going live. Financial 45% versus 28% on benchmark. 6 months 28% versus 15%. 3 months and 1 month also beat. So beaten in all time frames. Overall since live 25.8% versus 18.3%. Uh, the momentum type on this is rotational, 10 stocks that rotate on a monthly basis. Extremely good candidate if you don't have much large cap exposure. Nifty Next 50 is that category of stocks which have the capability to go to Nifty. So they are extremely, I would say, good quality stocks with growth, underlying growth sort of undercurrents that can help propel them into the Nifty at some point of time. The recommended capital is 5 lakhs to 30 lakhs on this portfolio. So this is all I have for my. I hope I didn't take too much of time. I am at 10:22. I'm 2 minutes late, but I will open up now for questions, and you can start sending in your questions, and I will now answer them one by one from 10:22 timestamp onwards. Okay. Satbir has the first question. One question regarding back testing. Should we adjust for short-term or long-term tax during back testing a strategy? So as long as your strategy is more or less even in terms of the churn and the kind of uh, movement that you are seeing in the stocks, the kind of stocks that you are testing on the sub segment, if that remains somewhat similar, then you don't really need to get into taxation. Because let's say in the last 1 year, if you can see that your churn, or last 3 years average, if you can take, if your churn is, let's say, 3x per year, then you can assume that most of your transactions are going into short-term capital gains, and that you can adjust. You can lower your returns by 15% and calculate that if you want a real post-tax returns. But long-term capital gains tax is also 10%. Short-term is 15%. So I don't think much difference will get made by doing this analysis. You don't need to really look into the backtest taxation precisely. You can take an average and do that. Sayyid Rizvi says, have you studied the allocation progression in percentages to large, mid, and small caps over the years since the strategy went live? So this is not exactly a fixed rate of allocation. So it's not like 33, 33, 33 that we have chosen. But yes, we have not done this study in terms of progression, how it has progressed. The current allocation is always available. If you go to the small case site and you go into the fact sheet, you will be able to see the current allocation. But no, I don't have the allocation progression. Chaitanya says, hello, Lok, is there a plan to launch one more HNI small case in all cap category? So HNI segment will have more strategies in the coming months. There will be at least one or two more, let's say in the next 3 to 4 months. One may come by the next month itself, and then one may come by March or April. So we have plans to do that in the all cap category. Yes. Um, Shivansh says how to reduce concentration risk in momentum investing since it's top heavy in nature. So top heavy meaning that if allocation percentages have gone up for some stocks, is that top heavy in nature, or the fact that the stocks themselves are reach some overbought or over kind of heavy nature, heavy gains in nature. So I'm not clear on that. But to reduce concentration risk, you diversify. You diversify within your strategy should have, like for instance, we have strategies that have even 50 stocks. We have strategies which have 30 stocks. Those are better diversified strategies than 10 stocks. Obviously, the 10 stock strategies are extremely concentrated and they should not be your core strategy. They should be an addition to your core strategy. And in general, also, I very much recommend that do not put all your money in one strategy, even though it may be doing very well. So if, let's say, MI20 is doing very well, don't put all your money in it. Diversify across strategies, have 2 3 strategies. There is a, in general, diversification that will come around even if there is some overlap, and you can check with our team what is the overlap before buying if you like. But some diversification is for surely uh, good for all strategies. Maulik says, in case inflation in India rises up, same as Turkey, after 5 years down the line, what should investors do as an investment strategy? Will momentum investing work and beat index? Yes, index plus inflation will get beaten by momentum strategies most likely, because stock markets will not fall because of inflation. Stock markets in nominal terms will keep rising as even our currency will take a beating. So if you look at the Turkey, Istanbul, what's the name called of the index? Istanbul 100 or something like that. Uh, that has done quite well in the last few years, despite their currency getting smashed. So nominally, you will keep doing well. Of course, you need to allocate in a big way to gold, to real estate, to real assets, because financial assets at some point of time, if inflation goes into a spiral, hyperinflation kind of a thing, that may that may have some impact on some sectors at least. But having that asset allocation is very important in uncertain factors uh, for this. So, whenever there is uncertainty, there needs to be um, allocation to real assets. Can you just give me 1 minute? I'll just need to, come back in a minute, and I will continue this. Just give me 1 minute, please. So sorry, I'm babysitting my pet. Nobody at home. So yeah. Uh, Next question from Prashant: is gold bees in evergreen strategy different from SGB? Yes, yes, yes. So sovereign gold bonds are issued by the RBI. They have a maturity of up to 8 years. They have maturity of 8 years. They are listed. Various different series are listed on the exchange, which are maturing in 2 years, 3 years, 5 years, 7 years. You can buy any which you like. Gold bees are ETFs, exchange traded funds. They are issued by private companies like Nippon Gold, like Kotak. Uh, they are very, very different things. One is a bond that which is tax free on maturity and also gives you 2.5% interest. Gold base is a exchange traded. It's like a mutual fund. Exchange traded fund is like a mutual fund with lower cost. Uh, but very easily, very liquid, very easily accessible. So my suggestion is, if you're looking at gold for short term, gold base is very good. If you are looking at gold for long term, sovereign gold bonds has no comparison. That's how I would. Tenny Cherian says, how would you invest your own rupees 1 crore portfolio across your products? So it again, it will depend upon what is my outlook towards what kind of growth do I want. If I want aggressive growth, I'll put 50% in mid and small caps, and I'll put maybe uh, you know 30% towards large and mid cap kind of stocks, and 20% I'll maybe invest towards some gold or something. So these are, it depends upon what is the risk profile, risk makeup that you do. But in general, a good mix of large, mid, and small caps, and some focused strategy, like for instance, ATH2, ATH. All these are focused strategies which are trying to get that alpha. I'll put 10-20% towards that if I were to sort of go to my third or fourth small case. Okay, next one is from Mr. Atit Tanak. Given the current market, how should one think about lump sum investment? Looking for a balanced. If you're not very aggressive approach, then don't look for lump sums. Gradually bring in the funds over a 6 month, 1 year period. Because see, the lump sums have an aggressive approach. Lump sum investing is aggressive basically. Lump sum investing means that I'm taking a bet that immediately there is no risk in the market, and any conservative person, not very aggressive person, will not take that bet. So of course you need to discuss this with your financial advisor also, who will according to your age, according to your goals, according to your current savings rate, they will advise you on how to go about it. But one would not think that a non-aggressive approach is not a lump sum approach basically. Shivansh says, in your experience, if our product is based on Nifty Next 50, we are ultimately letting go a candidate when it shifts to Nifty 50. So is that because this is a natural profit booking mechanism? Yes, you are right. So it has happened many times that we have had to let go of a candidate when it shifts to Nifty 50. I'm not recalling, but there was one candidate, I think Adani Enterprise, where it was in Nifty 50 and then it went out to Nifty, and it was doing quite well in Nifty Next 50. And when it was going out, we were like, we are losing a good candidate. Uh, so it is also a natural profit booking mechanism, but profit booking is happening on a monthly basis. See, in these strategies which are rotational on a monthly basis, we are booking strategies on a monthly basis. So Evergreen, NNF10, India Top 10 are reset to their base allocations every month. So in NNF10, stocks will come back to 10%. In US Top 10, 10%. In Evergreen, it will come back to 3.75% each. So in essence, if something is really going up, you are taking the profits off the table and allocating it to all stocks evenly. So that is the advantage, that if something goes up 5x, at every month level you are taking off profits. So while it is not compounding over in that same stock, but it is compounding overall, and that's a natural profit booking mechanism that we have in those strategies. Chaitanya has, is there a plan to launch one more HNI small case? I already answered this. I think, yeah, we will do that. How do we know whether two small case have an overlap? You can write a email to us. We will let you know. If it is a cross segment two small cap, then there will be no overlap. For instance, large cap versus small cap, etc. But if in the similar category, for instance, MI35 and MI20, they will have some overlap. But what we have seen is that the overlap is within any two products is not enough to suggest that don't take both. It is rarely that the overlap will have 30-40% overlap stocks. It will be 10% stocks, 15% stocks. That's about it. Night Fury has a question: why technical analysis like moving average or super trend not do so well in some stock exchange like Pakistan or China market and do good in US markets or India market? Okay, so I have not tried Pakistani or Chinese markets, but Pakistan should do well because Pakistan has a good trending index from the last what I remember seeing. Chinese markets is a not a very natural market. So China is like you know I would say fully controlled by the government, and the retail participation in Chinese market is very very small despite the large number of Chinese folks. China is a market that you may not want to compare with. But if you compare with, let's say, even a Japanese market or let's say the UK market, uh, there are strategies that will do well. Now, super trend or moving average is predominantly a trend based strategy. So if uh, and many of these are mature markets. So many European markets, for instance, are mature. Pakistan, I think should be trending, but they have their own lot of problems. So maybe the trends get chopped off before they even become meaningful. They have so many problems almost on a monthly basis. So why should we have any benchmark or discussion about them actually? So US and India markets are vibrant markets. A lot of money flows through them, US market especially, and hence the whole the market system is based on liquidity flows. Uh, it's a chicken egg problem. So you can argue that uh, liquidity is coming into a market because stocks are doing well, economy is doing well, or you can argue that the liquidity is anticipating that once it comes in, the results will start to become good. I think these are two lines of thoughts that happen, and possibly both are right to some extent. For instance, I'll give you one example which at least I did not realize for a long period of time, that a company stock which is growing, it gives it a unfair inherent advantage versus its peers. Let's say an Asian Paints goes up 5x in 2 years. Now they have that equity capital, and they can go around buying small companies with their equity. So this actually has become a way of fudging the market for some stocks. I'm not saying Asian Paints, but some other stocks that you build up your market cap and use your stock to then go into a share swap, buying out other stocks, buying out other assets, and then your market caps comes down. So liquidity is what that determines what is going to be the price and the market cap. And of course there is some connectivity with the potential of that particular asset or that market also. I hope some answer, near about answer, is there for your query. Siddharth says, if how to deploy a capital if you want to deploy around 25 lakhs in one strategy, wait for a pull down, or how much to deploy at once if I want to get maximum return possible. So to get maximum return possible from the point you invest, you should pray to God that give me this, huge return from this point onwards, and invest all your money at that point. That is the only way you will get maximum return possible. The other way, more normal way, is that uh, you gradually bring in your money and allow the strategy to do its thing over a period of time, let's say 4 or 5 years, and you compound it. As you get more money from your profession, from your business, you will keep deploying gradually, and that's how you will slowly snowball into a larger corpus. So this is the most common mistake that I have seen many people make, is that they because the market is running. For instance, now the market is running, a lot of people, and I'm not talking about you, Siddharth, a lot of people are feeling left out, that we have not, we deployed 10 lakhs but we had 50 lakhs in the bank. So we are left out, so now let's deploy 40 lakhs at one go because this is just a runaway market. Now who can say that we did not make a 2-year top yesterday? Who can say that? I mean, nobody can say that, right? And maybe we'll go to 20,500 and then drop to 18,000 again. Nobody can say it. So you have to be pragmatic, that it is your hard earned money, and we should not get greedy about returns, not worrying about the loss of capital. Our first, as I don't know, maybe I'm a very conservative person and that's why I say all these things. I don't want to lose capital. Let's put it this way. I don't like losing capital. Even if there is lesser return, I'm happier with the lesser return, but I don't want to lose capital. So I don't want to go 2 steps forward, 5 steps back, and then go 5 steps forward and then 10 steps back. I don't want to do that. I want to do 2 steps forward, 1 step back, 2 steps forward, 1 step back. That is the best I am able to digest. So depending upon your aggressiveness and your risk-taking capability, maybe you have 2 crores in your bank and you want to push 25 lakhs as one go. Then of course, definitely deploy at one go. We are now at a point where either the market will really go very up very fast in huge momentum, or we'll sputter around here at 20,000 and come back to 19,500, 19,000. So uh, the point is right to take the maximum bet, but how much risk you are going to take, that is something that you have to take a call on. What is the criteria for a bull market? Govind says, I am not sure how to answer this. When you see a lot of people happy around in the market, I think that's a bull market. That's the only definition I can think about. But conventionally, any market that drops 20% becomes a bear market, and then any market that goes near all-time highs becomes sort of a bull market, or 52-week highs becomes a bull market. So there is no one definition on this, but the general definition is whenever you see people bashing their managers, it is a bear market. Whenever you see people praising their managers, it is a bull market. That is another very good definition. So Haas says, you have spoken about allocation to gold, your age divided by half as percentage of your whole portfolio. In fact, not whole portfolio, I'm saying not total net worth. With gold going up like crazy, it has not gone up like crazy. It is just getting warmed up. I think again the same problem as with real estate, that 10-20% real estate goes up, people start thinking that it has gone up a lot. When gold will go up like crazy, it will double in 1 year. So you go look at the last 30-40 years of the chart of gold, and you will see there are phases where 50%, 70% kind of gains will come in 12 to 18 months. That is real going up crazy. So if we go from 63,000 to 1 lakh within the next 7-8 months, 1 year, that is a good move. Going up from 55,000 to 63,000 is nothing. I mean, it is just par for the course. 11 8% has been the CAGR the last 50 years. So at 63,000, if in a year we reach 70,000, it is just normal. It is nothing crazy, right? If you do 50% in a year, go 63 to 93, that is a bit crazy, and that crazy will come for sure. So physical gold is the, what's called the gold standard of buying gold, where there is no counterparty risk. And I'm probably at the cost of repeating myself many times, and I'm sorry those who have got bored of this repetition. There is no comparison of physical gold, although it is cumbersome to buy, to sell, to hold, to pay tax on it, um, to prevent it from theft. Yet it is the best way of holding gold, because there is no counterparty risk. What you hold in your hand is yours, it is internationally priced, nobody can really take it away from you. The second best is sovereign gold bond, which has the tax benefits, which has the counterparty risk as Reserve Bank of India. Of course, you will have to assume that the Reserve Bank of India will never go bankrupt, and it will never, go back on their promise that they owe you this money or gold. But there is a counterparty risk. Um, they also pay you some dividend, some interest of 2.5%, and it is very peaceful. It comes into your demat account. It is slightly illiquid, but it is good for holding to maturity. ETFs are very good for shorter term periods. If you want to buy for 1 2 year, 2 years, 3 months, ETFs is that vehicle that you want to choose. So, but yeah, coming back to your point, gold is yet to do crazy. Okay. Shivansh has another one. If we have allocated money to 25 stocks and one of them grows and becomes 10 12%, how to reduce exposure so that it doesn't make sense? So does it make sense to reduce exposure one third on every cutoff size? Again, it depends upon the design of your portfolio. Like for instance, I mentioned in rotational strategies, every month we take off the profit, come back to allocation. In other strategies, let's say MI, uh, which is now HNI Wealth Builder, if we allocate 2%, and when it goes to 15%, we will book profit and come back to allocation. In MIMT all cap, we start at 5%. If it goes to 15% or more, we'll come back to 5%. So it depends upon your design and rules of your strategy. Could be different for different strategies, could be different for you, could be different for me. Again, depends upon how you want to do that. Uh, in many strategies, uh, you will see that the ones that do well are actually pulling up this portfolio even more. So you may argue that it makes no sense to take money off the winners. But again, because we are running a public service, a public strategy, you may have gotten in at a point where it was 2% allocation and now it is 15%. But the guy who's coming in now does not want to allocate at 15%. So we have some constraints because we are providing a service. But in individual portfolio, maybe you don't want to take the money off. Rohan says, what do you think is the cap limit for a momentum strategy without impacting in returns in terms of slippages? Also concluding good returns, till what amount will HNI Wealth Builder will work? So cap limit is dependent upon the strategy, upon the kind of stocks, upon the selection of stocks, upon the number of people using that strategy. So there are so many variables around it. And let me tell you that no fund manager in this world, and I'm just uh, you know, a very, very small entity in this entire market. There are people who are managing 30,000 crores, 50,000 crores of assets. They are not able to buy or sell easily. So just to give you an example, a very famous small cap manager in 2018 got stuck. had 1,500 crores of AUM, which is not very large, but still 1,500 crores is 1,500 crores, and invested in 20 stocks. So he had to invest 75 crores per stock in his PMS. Now, the strategy was geared towards small cap stocks. Small cap stocks, average market cap is somewhere near 500 crores, 700 crores. Now, if you want to buy 75 crores worth of stock in a 750 crore market cap company, you need 10% of the stock. How you will get 10% of the stock? I mean, if you go to the market, you'll get maybe 1%, and that also after two circuits. So how do you get 10% of a company? The strategy failed. I mean, he had to suffer a lot because of this, because there is only certain limit up to which you can go into those kind of stocks. If you are small cap manager and you have 10,000 crores of asset, you will have to go to stocks which have that kind of market cap within the small cap region, where you'll be able to go in and go out without disturbing the market. And most institutional investors do not buy or sell in the market, they buy and sell amongst each other. Because I have been an institutional dealer from 1996 to 2000 in my broking days, I know that it is next to impossible to buy or sell from the market because there is no liquidity besides the top 200 stocks. And even there, the large cap mutual funds, the institutional people do not buy from the market. They do back to back deals, which is negotiated on the phone. Okay, we will do this trade on the screen at this time and at this price, and both come to the screen, and they do on the phone, 1 2 3 go, and both press the button, sell and buy, and this deal got executed. But very recently, a new news article came in Money Control that there have been uh, pirate algos, and I'm just saying, just for general information, pirate algorithms have been built by some people who are just hunting for this, that somebody puts a large buy or sell order, let's take quickly some of it away. And this is a split second things, this is in nanoseconds those orders are getting taken off. So imagine some institutional two institutions made a pact of negotiated deal. They came to the market, the sellers put his bid, asked this buyer put his bid, and somebody else bought this entire stick, and the buyer is left now having to buy from the market or from other sources at a higher price. Those kind of things are happening. So again, coming back to your point, there is no one limit for any type of strategy. We have restricted HNI Wealth Builder new additions to 100 seats only for this reason, and the recommended range is what we recommend you to go to. If you want to go beyond that range, you will experience slippages, not only for yourself but for your fellow members also, and it will ultimately result in this overall strategy not doing well. So please restrict yourself to recommended ranges. Do not adventure out of them. Tamal says, is it recommended to add more money at Nifty all-time health levels or wait for some drawdown? No, you can add money at any point of time. We will not be able to time the market at all. I'm the worst timer of the market, and most people who may claim that they can time the market well are not good timers of the market. The recommendation of coming it at any point is based on the fact that if we buy now, the market may be heading up very quickly, so you may benefit. If we wait for a drawdown, maybe we will miss this first move, and then whatever, the market goes up 5%, then comes down 2%, you may buy there, but you've missed this 5% move, right? So again, a very, very difficult call. If it gives you comfort that I'm buying whenever strategy has a drawdown of 5%, 10%, then yes, then you add money there only, if it gives you comfort. The whole idea of all these strategies is that you should be sleeping peacefully. You should be sleeping with the confidence that whatever money I put into these strategies will ultimately make me good money. There should not be any tension in your mind. You should be focusing on your job, your business, whatever profession, whatever you're doing. Your focus should not be on the markets, ideally. That is the whole idea and the basis of weekend investing that you look at the markets for just 2 minutes a week and live your life otherwise, fully in whatever you're doing, not be stuck with the screen. So I hope I was able to give some answer. Okay, last 5 minutes. Please stop adding more questions because I have 7 more questions. I think I will not be able to go through all of them, but I'll quickly go through. Siddhant Khanna says, purely from point of view of gold assets, why there is no symphony in their inherent market rates? I mean, prices are different. Why is that? So largely, if you will plot physical gold, SGB, and gold ETFs over a longer period of time, there will be a good symphony of their rates. Yes, because there is inefficiency in market pricing of SGB, and there is cost of running the ETF. 0.7% or something per year gets taken out. So hence those discrepancies are there. But largely, if we are looking at 11.7% gold, one may give you 11, one may give you 11.7, one may give you 12. That is the only range that is there. Chaitanya says, if the current value of the portfolio crosses 30 lakhs in MI cap, will the user be blocked from rebalancing? No, so you will not be blocked, but we'll recommend you that you add another strategy to your or to your portfolio, and we'll have more all cap type strategies in the HNI segment. So if you are going into the HNI, and congratulations to you if you're going into the HNI segment, you should try there. But 2 or 3 strategies, if you can diversify across, will be a good thing also. Prashant says, SGBs are also traded and a new buyer gets 2.5. Yes, all buyers, when the interest will come on the date of X interest, will get the money in the semi-annually in their bank accounts linked to their demat accounts. You just have to make sure that after you bought, your SGBs move into your demat account. SGBs are also, no, so I've already covered this. Dinesh says the underlying approach for all strategies similar. Yes, they are all momentum, except for number of stocks markets. So underlying theme is momentum. You can say, the tuning is different. Like you have a basic engine. Maruti will give you one basic engine, but 3 variants of its tuning. One is turbo petrol, and one is this, and one is that. But they're all, IC engines. So momentum is that kind of an engine with different kind of tuning based on different segments. So small caps require a different tuning. I can't afford to have 3 monthly rebalance in a small cap, but I can afford to have a 3 monthly or 1 monthly rebalance in a large cap. So different diversifications are needed, different tuning is needed for different segments. Vipul says, can you put all gold videos into one tab and also put chat option on web platform? And can you make videos on option analysis and stairs? Okay, many requests in this. The chat option is coming soon. We are already onto that. Gold videos, we will try to club them and put them at one go once we restart our YouTube strategy. If you go to my channel on YouTube and just search for gold, you will get all the gold videos. And can you make videos on options analysis and stairs? I can make some videos. We do a monthly video on that, but we will try to do more. Your suggestion is well taken. TC Dinesh says, when do you tune the strategies? Is it regular intervals? We never tune the strategies. The same strategies continue, and there is no change of strategy at any point of time. He also says, how big is weekend investing team science, etc. So we are nearly about 8 people now, and there are some more help outsourced help teams also. What would happen if weekend investing is sold off to a different owner? So I have no plans to sell it off to anybody. Alok Jain decides to retire, so I'm not having any plans to retire unless God has other plans for me. So there is no question of retirement for me. And my daughter Anandita Jain, who you may have seen or met at Hangouts, is very much now a part of weekend investing. She was working in a hedge fund and has now moved into weekend investing. So she is going to be learning the ropes over the next few years and taking the company forward. So there is no question of selling it off to anybody. What is the overlap between ATH and ATH2? Very minimal. You can just check with our team the current overlap. I think maybe 1 or 2 stocks at best. What is your opinion on Japanese yen? Is it poised for further devaluation or might go back up as soon as inflation tapers? So I think as long as dollar is softening, um, uh, the yen will strengthen against the dollar, but it is a race of devaluation amongst currencies now, and it's difficult to say because US needs a big devaluation to really kickstart itself. Uh, so there will need to be a Bretton Woods kind of a conference amongst all central bankers, what they can agree upon. But it doesn't seem like it is coming that way. Is the underlying approach across different? So I think we've already done this. Uh, I'm at the end of the time. Sorry, I requested for no more questions, but they keep pouring in. Next time, I will take up more of your questions. You can, if there's any burning question that requires immediate attention, so that you can invest or you can, buy or get out of some strategy or change into something else, or any technical question that is causing any issue in terms of your experience, do let me know. I am more than happy to address that. Our support system is very much agile. You can send us email. You can, first of all, have you all downloaded the app or not? Because I want all of you to be on the app. If you've not downloaded the app, please do so. The chat section on the app is extremely fast. If you can drop a chat on the app, one team member will get to you. You can drop in a mail to me if there's any question that that you're not getting resolution of. Alok at weekendinvesting.com. Support at weekendinvesting.com remains the major point of connect. And on Twitter and all other places also, I'm available if you want to drop in a message to me. Thank you so much. You came out in great numbers on a Saturday morning. It's very heartening to see that, and I'm always grateful and thankful to all subscribers and viewers of Weekend Investing to give us so much love, motivation, and constant push to keep pushing ourselves and to keep performing for you and for us as well. It's been a great journey so far, and we hope that we continue doing so. Thank you so much. Goodbye. Bye bye.